Hello and welcome to On the Record, I'm Mark Dreyer. In this episode we sit down with Qu Hongbin, HSBC's chief economist for China. He was previously a senior manager at Bank of China and a regional development planner under the Shaanxi provincial government and has worked in the financial markets for 15 years. In this interview he talks about weakened external demand and the downside risks facing China's manufacturing sector, what he expects to see in the future with the renminbi exchange rate and China's role in stabilising the global economy. After unparalleled growth over the past 2 decades, the Chinese economy is currently in the process of slowing. Earlier this year, the long-held target for 8% GDP growth was cut to 7.5%, and authorities have stated the need to shift from export-led growth towards domestic consumption. But with profits in multiple industries down, factory output dipping, and fears over a property bubble remaining, the bulls and bears are still at odds as to whether China can truly engineer a soft landing and achieve a sustainable growth rate, or if a hard landing is already underway. Qu Hongbin, thank you very much for talking with us and welcome.
Pleasure.
Now, if we could start, the central government's priority last year was to control inflation. This year it's more to stimulate growth while keeping an eye, of course, on inflation. How do you think China will fare?
Well, I think you're right. Things change so quickly. It's not as if they really want to, make a shift between inflation and supporting growth. But they have to do that simply because the economic situation has changed. So therefore, I think what we're going to see is basically just like they did in terms of the tightening cycle over the last year, the monetary, basically quantitative tools, this time around is also going to play a more important role than the price mechanism. So we're going to see more kind of reserve ratio cuts, a bit of increase in terms of annual lending quotas for the banks, and on top of that, probably see some kind of moderate cut in the interest rate. So this is on the monetary policy front. And also fiscal, the Beijing also have plenty of room in terms of fiscal easing in the fiscal policy front. Last year, China's government revenue has been growing at a pace of 26%, which is more than double the pace of GDP growth rate in China. So therefore, the government is in a pretty good fiscal position to basically to ease the monetary policy. How they're going to do that? How they are going to do that? I think firstly, there are more room for them to further cut the tax for the smaller enterprises, and also basically giving additional fiscal incentives to the to the consumer spending, and also increase the spending in the public housing area is also going to help.
Now, many of the biggest uncertainties, of course, stem from external demand. China's export growth has slowed recently, but not as bad as the market had anticipated. How big a problem do you think this is?
I think this is a big problem. Exports is going to slow further this year. The reason is very simple. The U.S. economy is slowing. European is going to slip into a recession. All the major emerging market economies, Brazil, India, they're all slowing as well. So we have a situation where everyone's slowing. So China, even if they still have a very competitive export kind of the product, but once the demand is slowing, there's not much China can do about that.
How can the market environment be improved for the manufacturing sector, and what are the biggest obstacles for that sector?
I have to say, unfortunately, the market conditions for Chinese manufacturing sector is not going to improve anytime soon. At least over the next 6 months, we are going to see a situation probably is going to continue to deteriorate. Number one, the external demand is going to become weaker. The number two, we also see the property market in China has already cooling. So that will have some kind of the impact in terms of the orders, in terms of demand for the steels, construction materials. So therefore, the manufacturing is going to face in China really challenging time.